What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Charlie and Ben with you here this week, unpacking the big scoops of the week that we've been working on. Charlie, how's your week been?
It's been good, much like last week and the week before. And, you know, like always, busy.
Always super busy.
Lots to write about.
Lots to write about. And this time of year as well, you know, coming up to the end of financial year, event season is in full swing. We're out and about doing things. We're seeing people. We're chatting to people. There's all sorts going on. Of course, the budget happened last week. So that was a big thing we were talking about last week, and the ramifications of that still filtering through this week. And all sorts keeping us busy. Ben, how's your week been?
Pretty good. I was sick last week, so thanks for filling in for me last week.
We missed you, but we were very glad that you didn't give us your germs.
No, yes, that's good. And I've got a shoulder injury at the moment as well. I think so. Kind of in the wars at the moment, but
we'll try and keep you in good spirits by chatting about the news that we've been writing about this week.
Yeah.
And of course, as we were sort of saying, the budget last week was the big topic of conversation. I think now it's been a few days. We've had the dust starting to settle, people looking at what does it mean? What does it mean for both borrowers and first-time buyers, but also for small businesses, for the general public? And I think some of the things that we've been hearing from brokers the last few days has been like, well, what does it mean for our investor clients? And we've been talking to a few brokers already about what they've been seeing and how they've been reacting. Of course, they've been super busy talking to their investor clients about what it means for them and what it means for serviceability. And that was some of the big things that we were hearing from lenders this week. We reached out to a couple to be like, when are you changing these calculations? What does it do to servicing? Because we were hearing that it was, for some people, it could be $500,000 difference.
Yeah.
Depending on how you've kind of set up your portfolios. But Charlie, you wrote a story this week for us on Macquarie, actually reaching out to brokers and being like, we're changing our calcs. What did they say?
Yep. So Macquarie is the first lender to move on adjusting its serviceability calculators for investment loans following the federal budget and the changes that were introduced in the budget last week, that being to capital gains discount, negative gearing and trusts. So like you said, Annie, I reached out to the major banks and also Macquarie because we were hearing word from brokers that they were getting correspondence from Macquarie about, we break it to you that the serviceability on this loan that you've applied for has changed significantly once we take out the add backs that we apply to negative gearing on an investor loan. So the banks have been doing this for years, that being incorporating tax benefits directly into loan calculators. So the changes are as follows. For buyers of new investment properties, contracts executed on or before Tuesday, 12 May, they will remain eligible for negative gearing add-backs in Macquarie's serviceability calculator. Eligible. And for contracts executed after the cutoff, the bank will only include negative gearing in the calculator if the property, as exemplified in the budget, meets the definition of a, quote, new build and, quote, genuinely adds to housing supply. So a pretty big announcement from Macquarie, and they connected that directly to the budget. We had a quote from a Macquarie spokesperson, and they linked the changes, obviously, in light of the federal budget. They'd made these changes to investor lending policy to ensure, quote, we continue to comply with our responsible lending obligations.
Yeah,
the spokesperson
it's
said.
Interesting because the legislation actually hasn't passed yet.
No,
so
it hasn't.
Even though we know the budget, they were saying it will apply for any houses bought after budget speech, basically 7:30 on the 12th of May.
Yep.
This isn't yet enshrined in law. It hasn't gone through Parliament yet, although we were hearing, from different mainstream media reports that they're looking to put it through before July.
Yep.
So it's not actually yet a thing. So it kind of surprised me that the Macquarie came out and has already started changing their calculations.
Yeah.
Macquarie generally moves pretty quickly with stuff like
They
this.
do. That is true. Yeah. They have formed for that, like the SMSF company trusts. They kind of move pretty quickly with every time there's a rate change, they move pretty quickly.
Yeah.
They are known as being dynamic.
Yeah. Agile,
exactly.
Yeah.
But yeah, you obviously talk to some of the major banks as well, as is always the case. If something happens, we want to make sure all the majors are asked, what are you doing? And as always, they said, not really anything.
No,
they were like,
didn't confirm or deny anything.
We will obviously
let you
look.
know.
Yeah, we
Yeah.
will look at our policies. But we did see that Westpac issued a statement to brokers, and I think this is because people have been talking about it a lot. And obviously, we have seen media reports saying that Westpac was looking at it, and they basically said to brokers, the proposals are yet to be passed into law. But we all need to take a balanced and considered approach that supports our responsible lending obligations. Current policy applies until further notice. We'll provide updates as further details on the proposed changes become available. But they did sort of suggest that obviously for pre-approvals that are in pipeline, they were like, when it comes to servicing, we will need to apply the current policy at that time.
Yeah.
So I think hinting if things do change and let's say the legislation passes and it comes into being, they're like, if things do change and by the time someone settles after legislation's passed, we'll obviously need to be re-looking at how we've actually conditionally applied that loan, approved that loan. So they're sort of saying unconditionally approved obviously won't be reassessed, but conditional approvals will be assessed at unconditional approval using the latest applicable credit policy.
Yep.
So TBC.
And same advice, obviously, from Macquarie. They're basically confirming that they're already effective for all applications.
Yeah.
So effective immediately, basically. Their policy has shifted.
Changed. Well, which is what I think that's interesting because it's the first one really to move bilaterally and kind of be like, we're doing it. Regardless of whether or not this legislation's passed. Westpac's kind of saying, we will share more details once the legislation passes, but kind of being like set expectations with your clients that this may change because the budget's been talking about it. Of course, we'll have to wait and see whether it actually passes through Parliament.
And there's also updated policy on, refinances and
what's that?
Well, for dollar refinances of existing investment properties purchased before 12 May, negative gearing tax benefits will still be recognised in the serviceability calculators. Where they said where borrowers are seeking additional cash out on a refinance, the bank would only include negative gearing on the extra debt if it is used to purchase another investment property with a pre-12 May contract to fund an eligible new build, as said in the budget, or to improve an existing investment property bought before the cutoff.
Yeah, so basically like for new loans and also for rebalances, this applies,
Yep.
Well, I think that's all pretty interesting. And of course, we'll keep you posted if and when things change, if we hear from more lenders. And if you're a broker and you're hearing from lenders that they're changing, let us know because we'd love to keep everyone else informed as well. It's hard to keep track with so many different policies. So we love it that our broker readers reach out to us and let us know when things like this do happen.
Yep.
We'll take a quick break here. We come back though, unpacking some of the things that are happening with cash rate trajectories and what the RBA is saying, what banks are saying, and we'll get into that just after this message. So this week we had the minutes from what feels like a long time ago, the May rate decision.
An eternity ago.
I know. I was like, that feels like, when did that happen? But the May cash rate decision that came down a few weeks back, obviously they increased to 4.35%. We finally had the minutes released. Charlie, you wrote the story for us, unpacking what the RBA was saying.
Yep.
What were the kind of highlights for you? What were the takeaways?
Well, it's always interesting to officially see what was discussed among the monetary board policy monetary policy board members.
Yeah, there we go.
So obviously there were two cases to hold, as it wasn't unanimous, but the opposing camp was only a single member.
Yeah.
So the winning camp, that voted to increase the cash rate, that case basically rested on arguments that emphasize uncertainty over the true extent of capacity pressures, the possibility that financial conditions were already kind of restrictive, and the risk that a prolonged conflict in the Middle East and the trade obstacles that have flowed on from it could weigh more heavily on household spending than on prices. That was the case to hold the cash rate.
Yeah.
This one member that voted against that, but ultimately that member was quashed with the 8 members that voted to...
Their vote was quashed.
Their vote was
Hopefully
quashed.
they weren't.
They weren't quashed. No.
Yes.
But yeah, the vast majority of the board kind of agreed that underlying inflation pre-conflict was already far too high, above that 2 to 3% preferred underlying mean trimmed band that they look for. And they said it was elevated, quote, for an extended period of time. And that members, quote, were not confident that at 4.1% the cash rate would be sufficient enough to mitigate the risks. And they also, funny enough, acknowledge, and this was evident in Governor Bullock's speech afterwards as well, that the central bank's dual mandate have become a little difficult to balance in the short term. We saw that today with unemployment figures, and we'll speak about that after. But them kind of preempting that and conceding that in May as well, that it's getting quite challenging for them to hold up two ends of the bargain.
Yeah. Because I think like that's it for at the end of the day. They're like, again, we talk about this quite a lot, but like it's quite a sort of hard tool for them to be like, well, we keep on having to change the cash rate, and that obviously impacts borrowers, but doesn't really do much for everyone else. And particularly with the budget, a lot of the questions being asked to the governor ahead of it was being like, do you see government spending as being an issue? And she was very diplomatic, but basically was like, kinda. But obviously isn't going to like wade into the political arena on this, even though Although would love her to.
I think her comments on government spending at the May press conference were probably her most kind of explicit yet.
Yeah.
But she was directing it at all state governments, not just obviously the federal government, and rebates and extending the fuel excise and public transport
because
rebates.
It's all giving people more cash in their pocket to spend, basically.
Exactly. And she kind of theoretically, obviously, the whole definition of, a rebate is it's inflationary by definition.
Yes.
So she kind of said, look, what do you want me to say? That's the definition of what you're asking me.
And then what can they do really when they've only got that one instrument?
Sort
of
the blunt instrument.
The blunt instrument, exactly.
Also, I'd just like to add that the most interesting piece of commentary from the minutes was the board noting that financial conditions would, quote, probably be somewhat restrictive. And the banks took that as, well, we think the RBA is comfortable in the short term of where rates are.
Yeah, and I think that's sort of what you said when you wrote the piece following the cash rate hike, following Michelle Bullock's comments from the press conference as well, was saying she now believes, tightening now gives them some breathing space or some space to actually review what does this do to inflation and have that kind of prolonged period. And as you mentioned, on Thursday, we had the unemployment figures come out, and that was actually a surprise for a few people. It was higher than people thought it was going to be. And of course, unemployment being higher is never a good thing, but we are at pretty low unemployment anyway. So I think most people were expecting it to be around 4.2, 4.3%. It actually was 4.5%.
Yep.
So some people were like, actually, weirdly, that's a good thing. Because
for households,
for cash rate, not for anyone who's losing their jobs, obviously. But they were kind of saying because unemployment has been so low for so long, a lot of what obviously the RBA has been worried about is saying inflation's going up, people are spending, they have jobs, they feel comfortable to spend.
Yeah.
And because it is generally quite low, they were like, it could go up a little bit and that wouldn't be necessarily a bad thing because people would stop spending and hopefully that would help inflation. But as we know, consumer spending hasn't been too bad.
No.
But given this and given the restrictive territory chatter, we have had some banks go back and relook at their cash rate forecasts, haven't we?
Yeah, we have. So as you said, on Thursday, the unemployment rate rose 0.2 percentage points to 4.5. And this is the highest level seen since the current tightening cycle began. So as you said, that low unemployment rate giving the RBA further headroom to think that they've got further headroom to hike without doing kind of damage or a considerable amount of damage to the economy because more people are employed. And that's now kind of being tested after these 3 consecutive hikes. So because of this, NAB on Thursday, the day that these figures were released, has gone back and revised its existing cash rate forecast. So they were flagging one more cash rate increase in June, so the RBA's next meeting. They've now revised that and they've pushed that back a month to August.
Yeah.
And they think
6 weeks.
Yeah. So, I mean, take it for what it's worth, type of thing. But they've basically said that this adds more credibility to the counter argument to hold rates on hold, keep rates on hold, and see how things progress.
Yeah.
Following the aftershocks of this conflict, and that maybe demand is slowing more than the banks and the RBA previously thought, because this has overshot the RBA's forecasts on unemployment. They'd forecasted it, as you said, to 4.3.
Yeah.
It's now tipped that far sooner than when that forecast that was mid-year.
And it's been interesting. I think even in the last week, we have seen quite a lot of people talking about restructuring and talking about redundancies. There's also been, lots of chatter around people being made redundant because of AI.
Yeah.
If you kind of look at the different titles that you have, we actually here at Momentum have a title that's about HR, and a lot of their conversations are around what jobs being lost due to AI, and kind of looking at the reshifting and reskilling of people. What does the new normal look like? But for this current period, going through some shedding of jobs, some slimlining of positions, and I think this will be the beginning of probably the next few months. We'll probably see some more because cash rate is higher, costs are higher.
Yeah,
people are starting to feel it.
Yeah, and the banks are now factoring these kind of higher than expected lifts in unemployment into their own forecasts too. It kind of ranges between all four majors. I think CBA is at the lowest end of the spectrum, flagging a 4.7% peak of the unemployment rate, and Westpac believes it'll be 5% by year's end. So a kind of range of figures there as what can happen, what could happen with the jobless rate. But obviously, the banks are saying it's no surprise with the conflict, as you said, kind of boom in AI, which isn't really receiving a lot of kind of coverage, and also these rising rates. It's an unholy mix.
It's crazy too. And when you see these sort of numbers reported, you see 4.5, 4.7, 4.8, and 5. It doesn't seem like a big difference, but it's actually a lot of people's
hundreds
jobs.
of thousands of people,
people's jobs.
Yeah, when you actually open the ABS file and see that a 0.2% increase is actually whatever it may be, 111,000 people.
Employment fell 19,000 people.
Yep.
Yes, and I guess that's why the RBA don't take these decisions
lightly. It's people's livelihoods.
Yeah.
But I think, it will be interesting. And I think, again, we always say this, obviously anyone losing their job is not great, but thank goodness we're still at a fairly low base. Let's hope it doesn't go too much higher over 5%. We want it to be still,
contained,
productive and still working well. But does show that things are starting to bite. So NAB changing its rate forecasts. I think everyone else, just off the top of my head, I can't remember what the other three majors were saying, but I think Westpac was saying 2. I wonder if they'll stick to their guns on that.
Yeah, Westpac's commentary was a little softer today, on Thursday, following the release of this data, basically stating that the wait and see case has gained further legitimacy, and they think a June. Keep in mind, Westpac also delayed their cash rate forecast. It was previously June, August. Now it's August, September.
Yeah.
They've basically gone, we think June is near guaranteed for a hold. And their language on Thursday for that case, was the strongest that I've ever seen from them.
Yeah. And I think, again, as you say, based off what Michelle Bullock was saying, it's that sounds like that's what they're thinking.
Yep.
Hard to always know what they're thinking, but that sounds like it. We're going to take a quick break here. When we come back, we'll be looking at, some more of what we're seeing from first home buyers and what's going on with the 5% deposit scheme. We'll get into that just after this. So we've been talking a lot after the budget about investors. I feel like I probably wrote the word budget about 200 times the last 3 days. But so much been going on. We've been focused a lot on CGT and negative gearing, what it means for investors, what it means for businesses and entrepreneurs. And a lot of the conversation has been, well, what does this mean for first home buyers? Because of course the whole premise was to help first home buyers, even though the capital gains tax discount has been scrapped and the minimum CGT 30% floor will be applied to all assets now, including things like assets held by younger people, such as ETFs and crypto, or at least the assumption is that it will be. So people kind of being like, well, actually, that's more of a problem, because if a young person wants to get a deposit and they sell their assets and they have this new CGT tax they didn't have before, or at least a higher tax than they were anticipating, that doesn't really work in their favor. And other people saying, well, it kind of again means that they're having to compete with investors on new builds, because all the investors will be moving to look at new builds for the negative gearing advantage, and saying, well, that's where a lot of first home buyers are currently in market. So again, sort of saying, what does this really mean for first home buyers? But we did get some interesting data come through this week around what has demand been like from this younger cohort. And again, looking at some interesting things and how incentives and guarantees and grants and rebates do play a major impact on how behavior is in market. This data came from Equifax, I think, looking at how the 5% deposit scheme's been influencing behavior. What were the findings?
So it was a really interesting piece of data. So they tracked mortgage inquiries under the 5% deposit scheme from October 2025 when the scheme was expanded to a wider pool of participants through to March 2026. So about 6 months or so, five to 6 months of data. And they compared it with the 6-month window before that, before the scheme was expanded. So first, we have a glimpse now of who is accessing the scheme, which age bracket is accessing the scheme. And it turns out that 18 to 25-year-olds, so Gen Z, first home buyers rose 22.8% over that 6-month period.
Wow.
And this was the fastest growing age group in the analysis. Followed pretty closely behind, although not so much, was 26 to 35-year-olds by 17.4%. So it's about 5 or 6% less. And then 36 to 45-year-olds by 16%. So almost equal.
Yeah.
So very much a younger skew.
Younger, 18-year-olds. God, 18-year-old buying a house. Jealous of that.
Unthinkable, yeah, I know.
I'm jealous of that. But yeah, I mean, it does show that's really what it's sort of intended for, is the sort of not only younger people, but also people with lower incomes. And typically the younger you are, the lower income you're on.
Yeah.
So sort of seeing this low income earners coming into the property market, that's a massive change, 22%.
Yeah,
6 months.
it is. And Chief Solutions Officer at Equifax, Kevin James, attributed this data as reinforcement that, as you said, Annie, when you do provide a policy incentive,
people will use it.
Exactly. This is proof and evidence of that younger Australians are really taking advantage of the 5% deposit scheme.
Yeah.
And a really challenging hurdle of home ownership is squirreling enough money away for that deposit.
Yeah.
It can be so difficult. And him basically saying, when you do offer that incentive, people are pretty clearly taking it. What I found interesting, and this isn't very, very interesting, but it kind of just reinforced what I thought before, was that scheme panel lenders of the scheme are really benefiting from the expansion of the 5% deposit scheme. So lenders that are participating in the 5% deposit scheme, loans under the 5% deposit scheme rose 16.4% compared with the previous year, while those that aren't participating saw inquiries fall by 6.5%.
That's massive,
that
isn't
is
it?
interesting.
And I think this
huge.
is the thing as well, because we know that ANZ wasn't on the first home buyer panel, and we've been seeing for a while ANZ flows falling.
Yeah, they went negative for
and now,
about a couple of months.
I think, I can't remember what month they actually came on now. Probably maybe around March.
Yeah.
But now they're on it. So I think that part of it might be that they were seeing these figures and being like, look at all the lenders on this panel getting all of this first home buyer business, and we're losing this business.
Yeah.
What did you say? 6.5% drop in first home buyer inquiries, at least to these participant lenders. So they're kind of being like, we want a piece of action.
Do you think we're going to see sustained demand from these cohorts over the next sort of 6 to 12 months? Or do you think with the higher rates, a few people...
I reckon it will still be pretty popular.
Yeah.
And I think particularly again with that really lower age brackets, people who traditionally have found it quite difficult to get onto the property market, I think they would still be really popular. And I reckon they'll be for a long time the predominant cohort of people applying for the scheme, because they're probably the ones that are the most challenged when it comes to having extra cash flow, looking for a deposit. But yeah, I do think, obviously servicing is still a big question that people are talking about, saying, well, rates keep going up and you've got the 3% buffer if you're a bank as well. It might be dropped down to 2.5 or something like that. But generally you've got to service them quite highly. And if salaries are not rising in tandem, how are you affording to repay this? And of course, all your savings are being put towards it. So if you do eventually buy a house, how are you going to afford to, pay your repayments if rates keep going up?
I've been speaking to brokers on the 5% deposit scheme, brokers telling me that borrowers are getting creative. They're looking further afield. They're adapting their preferences. They're looking primarily because they don't have a choice. The price caps that are imposed under this scheme, while lower than market prices, are still really unattainable for a lot of prospective home buyers out there. And that was also reflected in these figures, showing that 81.9% shifted to another suburb within their own state. 10% moved but stayed within the same suburb, so very much a minority. And even more interesting, 7.1% cross-state borders.
Yeah. Well, I think we
taking
know
advantage-
everyone's been moving to WA and Queensland.
Yeah.
So
Although, yeah, maybe not because prices are so much, but they showed that movers, the largest cohort of interstate movers are New South Wales residents relocating to Victoria, which accounts for 12.2% of interstate first home relocations, and New South Wales residents heading to Queensland at 10.4%. And also, on the loan size front, a shift obviously towards smaller mortgages and entry-level stock, and prices heating up on that entry-level stock. We keep seeing that in every data set that we get, whether it be from APRA or Equifax.
Vitality, yeah. And I think the other thing we've been seeing recently as well, as rates have started to get higher, is not only kind of people thinking about, well, what's happening with my repayments and my borrowing capacity, but also whether or not I even want to go and have a look at a house. We started to see auction clearance rates fall. I actually know anecdotally as well, I've got some friends who are trying to sell a house and it's taken them a lot longer than they thought it would. And they were like, we're just not getting the interest that we thought we would. It's in Bondi as well. It's been like, I thought it snapped up.
Bizarre.
But yeah, so they were just like, well, people are starting to pull back from purchasing. So yeah, it'll be interesting winter,
Yeah, I think so as well. And you asked that before, how long can you see this sustained level of interest? I mean, a lot of people have a lot of kind of, whether it be S&P Global Ratings or Moody's or even, International Monetary Fund have provided commentary on this scheme. And I think looking forward, they expect demand to gradually cool off.
Yeah.
But still, this is extraordinary demand.
Yeah.
So it's
And I
only
think
logical that happens.
it's always so easy for us, I think, to look at Australia in a silo and be like, oh, things are starting to look a bit tough. And it's like, it's still pretty good.
Yeah, it's coming from a good base.
People's savings are still super high, record amount of money in people's savings accounts. Savings rates are obviously really good as interest rates go up. That's the kind of thing that we keep forgetting about, talking about term deposit rates.
Yeah.
People are generally paid pretty well here. Unemployment is still relatively low, as we were sort of talking about. So it's still pretty good.
Yeah,
Shouldn't worry too much.
Touch wood.
Yeah, look at what's happening in the UK and be like, nah, I don't want that. But anyway, talking of which, if you're interested in finding out more about what's happening from the lenders, what's happening on policy, what's happening in broking space, and do make sure you come along to the New Broker Academy 2026, which is being run with the support of Bendigo Bank Broker. It starts next week. Very excited. So we're going to Brisbane in Queensland on the 28th of May, and then we travel down to Victoria to hold it in Melbourne on the 5th of June, and then we'll finish off in New South Wales and Sydney on the 12th of June. So we'll be hearing from lots of lenders on what they've been doing to help brokers kind of help their clients. We'll be hearing from brokers on how they've been building their businesses. We'll be learning the $100 million blueprint from Innovate Nick Riley. We'll be hearing about referral partnerships and how you can be doing that to success, like Blank Financial and O'Brien Real Estate has been doing. All loads of great broker feedback as well from brokers on different phases of their journey about how they've been growing, what they've been doing, how they've been generating leads, and of course support from aggregators and brokerages as well about what they've been providing to the broker channel. So much fantastic information, and it's free, if you can believe it or not. All you need to do is register at newbrokeracademy.com.au. Plus, for the first time this year, we will be holding in the same venue on the same day, New Agent Academy, which is for real estate agents. And if you haven't yet got a referral partner in place, then where better place to find one than at New Broker Academy and New Agent Academy, because we'll be doing a speed networking event where we'll be matching up brokers and agents to be like pretty much speed dating, but on a professional basis. So speed networking. We're always saying you could find a referral partner. You're on the same journey together. You're in your first few years of business. If you're thinking about where on earth do I get leads from a real estate agent, or if a real estate agent's thinking I really need someone who's pre-approved already so I can move quickly, then this is a perfect opportunity. So do make sure you come along, newbrokeracademy.com.au for the roadshow, which starts next week. I'll be there. Come and say hello. Ben, any nice plans for the weekend?
Probably going to lay low this weekend. Yeah, still recovering from various maladies and
Illnesses.
injuries.
Yeah, better.
Nothing too exciting.
Charlie, how about you?
I've got a solid weekend of mainly preparation for upcoming shows.
Yes.
And I've got my single out now in the world as well. So, just promoting that as much as possible.
Well, we'll have to play it next time we're on the podcast
Yeah,
so
we
that people
should,
can listen.
yeah.
Just a subtle plug.
If we don't get a copyright strike.
Maybe that's actually true.
On
I'll
the
have to double check.
outro music ever so slowly.
Maybe we'll just get you to sing it.
Yes, yeah.
Maybe that. That's a good idea as well.
Charlie Tchetch is the singer, if you're wondering what Charlie's talking about there. His
Yeah.
new single is out. But we're not here to talk about that. We're here to talk about mortgages. If you've got any other news for us, do feel free to reach out. You can reach me at editor@theadvisor.com.au. And of course, take a listen back to previous episodes on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.